At the recent PDI New York Forum, we met with Mike Arougheti of Ares Management. He talked about how non-corporate lending will be the next growth phase for the asset class. The focus will no longer just be on corporates, but also on the likes of real estate, structured finance, and asset-based lending. Well, Michael, thanks very much for joining us.
Thanks for having me. It's good to be here. Great event.
Great, thank you very much. So you were talking a little bit in there about the growth of private debt and how that had been a surprise to people who kind of were involved in the foundations of the asset class as you were. Do you think there's a lot more growth left, or have we reached a sort of limit now on how far private debt can grow?
It's an interesting question because, as I said in there, each time we've tested a new level of market size, we're seeing that the market is larger and larger, and I think it's for a couple of reasons. You have to think about supply demand and how capital's been aggregating against the opportunity. So as assets leave the banking system, we needed institutional investors to really buy off on the asset class and create that pull of demand. When we talk about private credit at Ares, it's not just corporate direct lending. I think that's the most visible market. And from what we can see, that's $1 trillion plus market. And I think it can grow, particularly as non-bank lending solutions start to globalize a little bit. I think it's more important that when we talk about private credit, we understand it not just to be corporate middle market lending, which is the most evolved, but any type of self-originated bilateral credit. So at Ares, while direct lending to corporates is still the dominant business, we're seeing disproportionate growth in real estate direct lending, where we're self-originating mortgage loans. We're seeing it in structured credit and asset-backed credit. So I think middle market corporate lending, we're still growing, but you'll probably see more market share consolidation than absolute growth, I think, given what we see in the market. But the non-corporate piece, we think, is going to be the next iteration of market development.
Okay, and as you've seen the asset class grow, you've also seen investor appetite grow and all sorts of new investors come into the asset class and create allocations. Where do you see growth coming on the investment side? Are you seeing any new investors coming in?
So the global hunt for yield or thirst for yield right now is insatiable. And now that we are talking about rate cuts and further easing globally, I think the demand for alternative fixed income product will continue to grow. What's interesting is 10 years ago when we started to see investors allocating to the space, it was largely coming from private equity allocations into higher risk, higher return private credit. And now we've seen a huge wave of capital coming in away from traditional fixed income into alternative fixed income credit, which for me means that the growth will sustain regardless of the rate environment, because now you have people allocating from both sides of that spectrum. But not surprisingly, a retiree, an insurance company, a pension fund, every investor, whether they're institutional or retail, has in their mind, I need to make 6 to 8%. The retirement budget in the condo in Florida requires it. The actuarial payout to the pensioners requires it. When rates are as low as they are, there's no way to actually deliver that 6 to 8% without private credit solutions, and that's why I'm so bullish on the growth of the market.
And yeah, as you say, bullish on the growth of the market. Nonetheless, people have their concerns. What do you perceive as possibly the biggest brakes on potential activity in future, the biggest challenges that the asset class faces?
I think the asset class is durable. I think part of the challenge is that, again, if you believe that a lot of these assets used to be financed within the banking system, a lot of people haven't seen them, and so they haven't been able to underwrite the asset class through the cycle. Now, certain managers, like Ares and others, now have 15 to 20-year auditable track records at scale that I think demonstrate the durability of the asset class, which will give people continued confidence. But I would imagine we'll go through a downturn. Certain managers will perform, certain won't. In the aggregate, I think the asset class will prove to do exactly what investors expected it to do from an investment outcome standpoint, and then we'll likely see consolidation of share and then continued growth. But I'd expect you'll see a pause in the action once we finally get to this downturn that everybody's been talking about for so long.
And just picking up a little bit on a point you're making there about track record. So obviously Ares has its long track record. One of the things that people are talking about is how some managers have not been through kind of the downs as well as the ups, because things have been benign for quite a long time. Do you have concerns around that? And are LPs almost putting too much faith perhaps in managers who haven't been through the downs as well as the ups?
I don't worry about it in terms of my business. I also don't worry about it in terms of the viability of the asset class, but I agree with the point, which is in any asset class, manager selection matters sometimes more than people think. I think there's a risk in the credit space to believe that making a 6 to 8% return is easier than it looks, and so people are allocating to the asset as much as they're allocating to the manager, and that may not end well. The reality is there's pattern recognition in any investment business, and the longer you've been doing it, the more you see the pattern, the more you recognize it, and the more your historical experience informs what you're doing now. So for someone like an Ares who's been in the credit markets for 25 years, through multiple cycles, we've seen a lot, and through avoiding certain risks that other people are taking, we think that we can continue to outperform. So I think it's going to be natural, just given the growth in the market, that you'll have people that underperform, but I'm not worried about it impugning the viability of the asset class in any way.
Yeah. Okay, final question for you, Michael, and slightly tongue-in-cheek perhaps, but are the sort of lack of covenants in deals today a recipe for the distressed opportunity of tomorrow?
Maybe.
Okay.
Maybe, and this is what's so interesting. So if you look at the last downturn, which was severe, in some respects, a covenant-light loan was an indicator that you were lending to the highest quality company. So only the best credit could get a covenant-light loan. So in good credits, covenants don't really matter. Credit people don't like to actually talk about that, but the reality is if you're good at underwriting and good at credit selection, you rarely open the document. So the question is, in poorly underwritten loans, do the covenants matter? And the answer is absolutely they do. I think part of the issue is right now we haven't really tested the full spectrum of the new document. So it's not just covenant light or covenant loose, but it's structural definitions of EBITDA and restricted payments baskets. There are all sorts of structural nuances that will change the way companies and balance sheets get restructured. So I'm not sure that the lack of covenants will lead to distress. It will actually prolong the benign environment. But when we actually start to see distress, it will be liquidity driven. And that's when we're really going to test both the mettle of the equity investors to see what companies they will support and be able to support, but also how these documents will perform. And candidly, it could go either way.
Okay.
So that's one thing that we all have to look forward to.
Great. All right. Thank you very much.
Thanks for having me.
Great.
Really appreciate it.
Thank
Have a
you.
good day.
Thanks.